So in our first example that I gave you was that Royan had a new policy that he decided to give away. And at that point, of course, the only charitable receipt that he would get would be the premium itself, in this case with $12,000. What if he has an existing policy? What if he has a policy sitting on the shelf right now and he's basically saying, I really don't need this anymore. My needs of, my family's fine, my taxes are paid, everything is fine. I would like to leave a lasting legacy, so to speak, to my favorite charity. So rather than cash the policy in, I'd rather just donate it. Okay, I'm going to donate it to a charity. Once again, absolute transfer, all that kind of stuff there. So at the time of transfer, basically the cash surrender value or the fair market value, was $50,000. Okay, so that's the magic number. Was $50,000. So he's got basically a cash that the charity could access, either by withdrawing or borrowing or whatever it is, so $50,000. The premium, if you remember, was $12,000. So the premium hasn't changed. So that's essentially the policy that he's got. He decides to transfer that policy on an absolute basis to his favorite charity. So what will happen is two things in this case. First of all, he will receive a charitable receipt for that $50,000. In other words, the cash that's in the policy itself, in other words, the fair market value of that policy, is a charitable receivable amount. Okay, so he will get a receipt, basically a charitable receipt for that $50,000. Okay. Also, he's going to receive on an ongoing basis a charitable receipt for $12,000 per year, which is the premium that he's paying. So he's got two situations here. He's given away a policy that has cash in it, whatever that fair market value of that particular policy at the time of transfer. In this case here was $50,000. That'll be a one-time tax receipt, basically. And then on an ongoing basis, as Ryan continues to pay his premium year by year, he's also going to get a $12,000 tax receipt in our particular example. Okay. Now, if you remember, we said that this was an absolute transfer. So basically, when you absolutely transfer, and remember also that this is now an arm's length transfer, okay, not a non-arm's length. It is giving to basically a stranger, you might say, okay? And so therefore giving it to a charity on an absolute basis, that would be considered an arm's length transaction. So therefore, there is going to be a deemed disposition problem. Okay, there will be a deemed disposition. So let's assume now that the adjusted cost base was $10,000 in that policy. Okay, was that the ACB was $10,000. Okay, but remember when you transfer it over, it was $50,000 was the proceeds that you transferred over. So again, going back to our famous formula of the policy gain, the difference between the proceeds, which in this case is $50,000, and the ACB, which is $10,000, as an example, that $40,000. That will be considered policy gain, and therefore, once again, it will attract tax based on Rohan's marginal tax rate. So you might say, well, that's no good. I mean, he's got a tax issue already by giving this policy away. He's got a tax issue because he has to pay the tax. The difference between the ACB and the fair market value of that policy, okay? And that is true. Because it is a deemed disposition because it is an arm's length transaction. Okay. However, don't forget, he's getting a tax receipt for $50,000. So really, what that tax receipt will in effect negate any kind of tax issues. So is there a tax issue? Yes, there will be, because there is a deemed disposition problem, and therefore it's an arm's length transaction. So yes, there will be a tax issue. Will there in fact be any tax paid? The answer is really no, or if there is, it'll be very, very small, if anything at all. Because the tax receipt that he's going to get, that $50,000 tax receipt, will certainly negate all the portion of the gain, and so the end result is really that it becomes a nice transaction where there's really no tax or minimal tax involved in all this here. So essentially, once again, it's an excellent way of leaving a legacy to a charity, getting a tax receipt right up front. Basically, so you have tax relief while you're alive, and so on and so forth. Okay, and once again, I want to stress to you that the $500,000 death benefit is not receivable. Okay, because remember they own the policy already; it has already been assigned, and so therefore it is not receivable. So the $500,000 is not receivable. Okay? But the cash value that's in that policy, that's receivable. The ongoing maintenance of the policy, like paying the premium and everything else, that's receivable. But the actual $500,000, that is not receivable. And the last thing to emphasize is that, is there a possibility of policy gain? The answer is yes. But will there actually be any tax involved? Highly unlikely, because tax receipt will basically negate any kind of tax issue in that particular case.